Thank you for joining us here this morning. So I'm pleased to present, to start with the two presenters for our first panel on what's not up with inflation, and that is, it's all about monetary policy and it's all about inflation expectations. So we are very fortunate to have two presenters. First, Silvana Tenreiro, Professor of Economics at the LSE, and of course, an external member of the Monetary Policy Committee for the Bank of England, and so puts her work in practice. Second, we have Michael Weber, is an associate professor at University of Chicago, who has done very innovative, voluminous research on how households form inflation expectations. So without further, I'll just have Silvana start.
Thank you for having me. And as Janet Yellen just said, in the past few years, several academics and practitioners have observed that the Phillips curve, the relation between inflation and measures of slack, has flattened or even disappeared. Some studies even highlighted that inflation appears to follow a totally exogenous process unrelated to those measures of slack, such as unemployment or the output gap. This led some academics to argue that the disconnect between inflation and measures of slack poses a big challenge to the monetary policy framework currently used by major central banks like the Fed, which uses the Phillips curve as a key building block. So in my work with Michael McLeod at the Bank of England, we asked the question, does this disconnect between inflation and measures of slack really pose a challenge to the monetary policy framework? And our answer is no. On the contrary, the disconnect between inflation and unemployment, or the output gap, is actually what a new Keynesian framework, like the one used in central banks, with a Phillips curve, and a central bank that has a dual mandate, as in the Fed, would actually predict. And let me try to make my argument using a simple version of the new Keynesian framework used in the central banks. So our central banker has a dual mandate, with the remit of achieving an inflation target and full employment or output at its potential. And this is represented here by this simple formula that says that the central banker minimizes the deviations of inflation from its target, denoted here by pi t, and deviations of output from its potential, xt. And the lambda letter here captures the relative weight that the central bank puts on output stabilization vis-a-vis the inflation target. So the central banker minimizes these deviations subject to a structural Phillips curve or aggregate supply constraint for the economy. This supply constraint is very intuitive. It says that when output increases relative to its potential, the output gap increases, that puts upward pressure on wages and costs, causing prices and inflation to increase. So the kappa here is positive. I can't point. It's not working, okay. This Phillips curve in blue here can be also shifted around by cost push shocks, such as oil shocks or changes in firms' markups that are collected in the term UT. And it can also be affected by changes in expectations of future inflation represented in the first term. Now, the solution to this optimization problem by the central bank is a targeting rule depicted in red, which is also very intuitive. It says that when the central bank sees that inflation is set to rise above its target, she will withdraw stimulus from the economy, causing the output gap to fall. This targeting rule imparts a negative relation between inflation and the output gap. So I plotted the two curves in this simple diagram. We see the upward sloping Phillips curve in blue, and here under the assumption that inflation expectations are anchored at the target and there are no cost push shocks, and the downward sloping targeting rule depicted in red. Now, in equilibrium, we only observe the intersection between these two curves. We don't directly observe the Phillips curve or the targeting rule. So we face what in economics we call a classical identification problem. Now, this identification problem is made more difficult by the fact that the Phillips curve can be shifted around by cost-push shocks or changes in inflation expectations. So here, an observer or naive econometrician trying to run a regression of inflation on the output gap will actually trace the wrong slope. We'll only see the response of monetary policy to cost-push shocks, so we'll be identifying the targeting rule rather than the Phillips curve. So 2 lessons from here. If monetary policy successfully offsets all demand shocks, then all what's left is these cost-push shocks, which will trace the wrong slope. And the second lesson is that in equilibrium here, inflation will inherit all the properties of the exogenous cost-push shocks. So effectively, we will see inflation following this exogenous process with the persistence of this process, but we won't see the correlation with slack that we would expect from a Phillips curve. Just a couple of more remarks on this. The model I just presented you has a very healthy Phillips curve by assumption, and yet we cannot see it in equilibrium. The argument I'm making here is slightly different from the one on anchored inflation expectations reducing or weakening the reduced form correlation between inflation and slack. My argument says that independently of inflation expectations, the structural relation between inflation and slack will always be masked by the conduct of monetary policy. Now, of course, as Janet Yellen just said, if monetary policy affects inflation expectations leading to an anchoring, that effect will also add or go in the same direction, so these 2 effects are in some sense complementary. Let me go back to the identification problem now, and how can we see this Phillips curve? So ideally, what we would like as econometricians is to have a very stable Phillips curve so that it doesn't move around, or we control for movements in that, and have deviations from the optimal targeting rule, some shocks to that optimal targeting rule. In that case, so if we have demand shocks that move us along the Phillips curve that are not offset by monetary policy, we'll be able to trace the right slope. This is easy to see in the simple model, but it goes through in a more complex quantitative setting that models that central banks are using as well. So just to summarize, in order to actually see the Phillips curve in the data, we need to control for supply shocks. That's not simple, and it's not sufficient. It's not simple because many shocks to the economy are part supply and part demand. And it's not sufficient because, again, we need these demand shocks to move us along the supply relation or aggregate Phillips curve and are not offset by monetary policy or other policies. Now, in practice, economists or econometricians have used monetary policy shocks, deviations from optimal policy due to mistakes in forecasts or judgment, and that allow them to identify the Phillips curve. Now, interestingly, those monetary policy shocks, or fortunately I should say, have become very small and infrequent since the 90s. So it's much more difficult to use them to identify the Phillips curve. What we use in my work with Michael McLee is disaggregated data, disaggregated at the regional level, in order to identify the Phillips curve. The idea here is that monetary policy offsets aggregate demand shocks to the whole country, but does not offset regional demand shocks. So from the perspective of a region, monetary policy is suboptimal, and the region might have an open output gap or higher unemployment than the average. So we use this idea to identify the slope of the Phillips curve. Here I'm showing the outcomes of regressions of US metro area inflation on slack. from 1990s onwards. This is a period of a very flat aggregate Phillips curve. And each regression here regress core CPI inflation at the metro area level on the unemployment rate. So in unemployment space, the Phillips curve is actually negatively sloped. So just adjust that vis-a-vis the graphs I showed before. We control for inflation expectations, and we control for lags in inflation. Now, if we don't use any other controls, the slope coefficient will be very similar to the one we obtain with aggregate data. And it's speaks of a very flat Phillips curve with a coefficient of 0.15. Now, I would like you to focus your attention on the last column. Here we control for time effects, so controlling for any aggregate supply or demand effect, including the effect of monetary policy at the aggregate level, and we also control for time invariant regional specific effects. Now, when we do that, the slope coefficient increases to nearly 0.4. So this is the very healthy Phillips curve, the type of numbers we tend to put in our models. And it's in line with the intuition from, or the insight we get from the model, that at the aggregate level it's very hard to see the Phillips curve because monetary policy is offsetting demand shocks. But we can see that by looking at regional or disaggregated data for which monetary policy is not offsetting demand shocks. So I'll leave you with my summary. I like to add just, a couple of remarks. The reduced form correlation, or Phillips curve, is a mix of supply and demand factors. Monetary policy is one of them. For individual episodes of missing inflation or disinflation, such as the Great Recessions, the theory and the data point to a variety of factors. On the supply side, large cost push shocks, such as what we saw during the recession, energy prices were going up, productivity fell, and there was a large financial shock. All of them contributed to higher costs and also pressed down on activity. And as Janet also mentioned, there are arguments about the measurement of slack, and many people have argued that other measures of slack, such as short-term unemployment, for example, didn't go up by as much as total unemployment during the Great Recession. So maybe that one was overestimated at the time. I conclude here and happy to take questions. Thank you.
Thanks a lot for putting together this amazing event and for having me today. So what I want to start out with is actually what Glenn alluded to at the very beginning when he said, typically when we write on models for policy recommendation and policy analysis, we would assume that there's a representative agent that is all available information, forms expectations rationally, and then would actually, whenever there's any new information, immediately update his or her expectations and then accordingly change savings and consumption plans. To get an idea actually whether this paradigm, given that we see large deviations oftentimes in data, is actually maybe a useful framework for policy analysis. We fielded together with Oli Korbio and Yuri Gunichenko in a representative sample of 20,000 Americans spread out across the whole country, just a survey to get an idea whether individuals have a good understanding of basic policy paradigms. And so what we found, and this is maybe, a nice interpretation, so on the one hand you see between 20 and 30% of the average American tends to have actually an understanding that the Fed aims to maybe achieve in longer periods of time an inflation rate of about 2%. So people have an understanding what an inflation target is, but what you also see is that there's this big chunk of the population, more than 40% in our sample, that answered a number larger than 10%, some of them even as large as 50%. So of course now, what does this mean? So there's a benign interpretation of this finding, Policymakers, many of whom are in the room, have done an amazing job over the last couple of decades, bringing inflation down, low and stable. So therefore, the average American maybe doesn't care about inflation expectations on a daily basis. But of course, there's actually not an innocuous interpretation, because in times such as now, when there's only limited space to go even lower in interest rates, and as we, for example, see in the Eurozone right now, where we might run into constraints next year on how much QE we can do, communication might be the only game in town. And if the average person does not actually have a well-understood understanding of what basic policy aims are, it seems hard that by moving to more directed communication, you can actually indeed achieve maybe big demand stimulation by moving inflation expectations. Now, of course, motivated now by this finding, we tried in some other work together with Ulrike Malmentier and Francesca D'Acunto to figure out what are the sources of information people would use when forming inflation expectations. To some extent, to our surprise, the most predominant source in a survey of 50,000 Americans fielded like a few years ago was people's daily grocery shopping experience. So people tend to focus on the price changes they see when shopping to form overall inflation expectations. To now directly document that in the data, we paired up with Nielsen, and here for those 50,000 people we surveyed ourselves, we actually were able to observe at the daily frequency the type of goods they purchased over the previous years, as well as the prices they did pay for those goods. So therefore, what you can do, you can construct, similar to the Bureau of Labor Statistics, a measure of household CPI, what is actually the past inflation at the shopping bundle of individuals, and pair it up and to see whether heterogeneity in past observed price changes does matter for inflation expectations. And what you see here to the far left, those are individuals that had the lowest degree of observed inflation in the shopping bundle. So their inflation expectations are about 0.5 percentage points lower than the inflation expectations of individuals that had the highest past observed shopping bundle inflation. Now, of course, you might say, well, this is already kind of surprising, given that what we see in Nielsen is only about 20–25% of overall consumption expenditure. So therefore, you might actually even expect that maybe it is not that every price change is created equally, but maybe individuals might even focus on specific goods when forming inflation expectations. And that's actually indeed the case in the data. It's not like individuals would actually use expenditure shares in Nielsen to weigh price changes. Instead, actually, think about milk. For all of us in the room, milk has a tiny expenditure share, but some maybe buy milk 10 times a week and others only 1 time a week. And it's indeed that the frequency of shopping seems to be determining the price changes people actually tend to focus on. Now, what does it mean for policy? Of course, there's a concern. This might undermine policy credibility, because if you think about the inflation measure, many tend to actually focus on core inflation as an indicator for inflationary pressure, tends to actually strip off completely all those volatile price changes that instead the average American tend to focus on when forming inflation expectations. Now, to get an idea whether actually now indeed, on the one hand, there's what might help explain this heterogeneity, there are maybe some observable characteristics, but also motivated by this recent theory work by Mike Woodford, Fari Werning, and Saviga Becks, that actually argue that maybe the reason why we see, let's say, a forward guidance puzzle, the fact that promises to keep interest rates low for an extended period of time might not be as effective as our benchmark model might predict. There has been this idea that maybe cognitive frictions, maybe some kind of naive behavior could partially help explain those differences in policy effectiveness. And so what we did here, we teamed up with the Bank of Finland, where we now, for all Finnish men from the military, we can observe a measure of cognitive abilities, and then, being a Nordic country, we can link, based on personal social security numbers, this measure of IQ in the survey to individual inflation expectations from the European Commission consumer survey, and also household balance sheet, income, and all of that, to then actually get an idea whether indeed there's heterogeneity in the degree of how well people are informing expectations, how well people are in actually prescribing to the prescription of our basic models. And all I want to take you away from this figure here, if you go all the way to the far left, those are the men in Finland with the lowest measure of IQ. To the far right, men in Finland with the highest measure of IQ. And you see on the y-axis the mean absolute forecast error for inflation. And all I want you to take away from here, you know, there's vast differences in how well individuals are in forecasting inflation by measured cognitive abilities. But this also then directly translates into policy effectiveness. What we can show in the data is that actually the top 50% of the IQ distribution, they pretty much behave as we would model them. You know, they increase their consumption expenditure when they have high inflation expectations. When the ECB lowers rate, they take out more loans. When the ECB actually increases rates, they take out less loans. So they indeed actually behave as we would hope to behave. The bottom 50% instead does not react at all. And I think we can convincingly show in the paper it's not due to financial constraints and other potential alternative explanation, but it indeed seems to be the case that there's a limited understanding what policymakers try to achieve. And of course, this then also raises potential concerns. If you do not well communicate with ordinary people, there might be a concern of redistribution. Now, to directly show you that there is indeed evidence that the complexity or simplicity of policies seem to be important for their effectiveness. I'm not just documenting some micro-survey data from Germany, and two policies that are somewhat different in how much basic understanding Germans have to understand the policy transmissions. Both of those policies rely on the consumer oil equation. So what does it mean? You know, you raise inflation expectations and then hopefully people start consuming more. The left policy we hear, what we label in this figure unconventional fiscal policy. This was when Chancellor Merkel in 2005 was first time elected in Germany. She announced immediately that she wants to raise VAT, so consumer taxes, 14 months down the line from 16 to 19%. And what you see after the announcement and before the effectiveness of the raise in consumption taxes, in the top panel, inflation expectations went up immediately. In the bottom panel, bottom left panel, you see that Germans on average immediately went out, started consuming more. Instead, actually in the right panel, you see the first two announcements of Mario Draghi of unconventional monetary policy in the summer of 2013 and in January of 2014. And at least when you look at households' expectations and their purchases, those two announcements had no effect on the average German, but also in all different type of subpopulations we studied. So it looks like simplicity and complexity of policies matter for the effectiveness. And then, of course, maybe also this means that we might have to think harder on how we want to actually communicate policies so that actually everyone tends to actually behave as we would hope to. Now, actually, to close the circle, and also a little bit end on a more benign or positive outlook, we actually want to now go back to this initial paper with Korobio and Gorodnichenko, in which we actually then try to do an information experiment or a so-called randomized control trial. So what we do and think about, so I now ask everyone here in the room, what do you think is inflation over the next 12 months? And then just randomly group people into 9 different subgroups, and then each subgroup in a random fashion gets a different piece of information relevant for monetary policy. And subsequent to this information provision, I ask everyone again what his or her inflation expectations are. And I want to understand whether, in case you are able to talk to people directly, does it affect individuals' expectations? And what you see here in red, there's actually strong evidence that if I tell people the Fed targets an inflation rate of 2%, you see this very strong reaction in inflation expectations. So it's indeed, if you have a way of communication directly with ordinary people in the US, people do react to it. But the second thing you also see now in blue, so oftentimes one argument is, you know, we have now press conferences, the media reports about our policy actions, so therefore there's maybe no need of direct communication, but I could indirectly rely on the news media to effectively convey my message. When we actually forced individuals to read a newspaper article about the most recent FOMC meeting, you see that actually the reaction, at least in our sample, was only half as strong. So on the one hand, I think the bigger challenge is to get people to read newspapers, but even once you actually force them to read, they seem to systematically discount that information. And let me actually end on maybe some of the conclusions of the paper. So there is hope that if you are able to directly communicate with individuals, they do react, but simple messages seem to be important. And one-off messages might not be enough for the repeated communication. Thank you.
So thank you for two terrific presentations. I thought I would start with a few questions to let these authors elaborate even a little bit more on what they've just said, because there's a lot of richness behind what they've said. We'll do that for a few minutes, and then we will also take some audience questions following that. So maybe, Silvana, if I could start with you. You know, pretty compelling evidence that there is this underlying Phillips curve alive and well once you control for the supply and demand shocks in your way. But we still have this puzzle of inflation's been below target in the United States for the last 10 years. And can you say something about whether, do you think it's more attributable to cost shocks or demand shocks, or, you know, your model assumes there's sort of effective monetary policy, but we have this weakness in inflation over the last decade, and how would you try to parse out, if you could, from your model or just your judgment?
Okay. So one thing that we observe right now is that, let me speak for the UK, that the Phillips curve in terms of wage growth and unemployment, wage inflation, is very evident and very healthy. We have very low unemployment as in the US, and the last reading of wage inflation has been 4% in annualized terms. So that's a very healthy and alive Phillips curve. Now, the big puzzle is why this wage increase is not being passed through onto prices, or not as strongly as we would have expected. So a couple of reasons. Obviously, wages are not the whole story, so there are other inputs into production, and it's possible that some of them, like, you know, commercial rents, are dragging down on inflation. Another possibility is that lower markups are absorbing part of the cost increase from wages. So this wage increases are not being passed through to prices right now, but it's a matter of time. And another possibility is that productivity growth is higher than what we are measuring currently, particularly in retail, and so the cost increase is not as high as we would increase. So I think we need to investigate all these channels, and probably the truth is, has a share of each of them. So in terms of wage space, which is the direct connection with unemployment, we're seeing it, and I think also in the US, though to a slightly lower extent than in the UK. And the question is, when will this be passed through to prices? My own sense is that it's just a matter of time.
Just a matter of time. Okay, thank you. So turning to Michael, so some compelling evidence about household formation of inflation expectations, and that households may not be that well informed, but can be sort of trained. So can you talk a little bit about whether households, does it matter if it's households or professional forecasters? I mean, inflation models are about firms as price setters, but in the US we have households and we have market or professional forecasters. Does it matter? Is it sufficient for market participants to understand? Do you need households to have accurate inflation expectations for policy to work?
So I think you raise an important question. So, at a basic level, the type of models we typically would write down, they have consumers consuming and savings. They have firms setting prices and hiring people. Typically, at least the models I write down, they don't have professional forecasters in there. And they also do not or rarely have financial markets in there. So ultimately, at least through the lens of our model, what I would take away from that to actually understand how effective policies are in stimulating aggregate demand, we ultimately do have to understand whether those people we model or hope to actually capture actually do react to those type of policies. Now, of course, Nelly, as you alluded to, unfortunately in the US, at least up to now, we do not have a good survey of firm expectations. But so we can actually go back a little bit to other countries where we actually do have good evidence. So for example, there's a very nice paper by Kopio and Gorodnichenko who fielded their own survey in New Zealand. And what they actually found in New Zealand is that if you look at the expectations of firms, they're pretty much identical to the expectations of households. Instead, if you would compare the expectations of firms to the expectations of professional forecasters, you see this big gap. So therefore, to the extent we can extrapolate, this would tell me that even in the US, most likely I would expect firms to be way more similar to households relative to the maybe well-anchored expectations of professional forecasters. Now to actually go to the second point of your question about financial market participants. So one concern there is, of course, that what you measure are risk-neutral expectations. So a different way of saying it, they might be so-called polluted by measures of risk premia. And we know, of course, also since the work by Ben Bernanke and Kuttner that actually monetary policy can move around risk premia. So it's always difficult then to infer from movements in financial market expectation that it's due to indeed the expectations component or from the risk premium component. And so therefore I think we can learn important things from financial markets, but I think ultimately we have to better understand households and firms.
Right, interesting.
If I can add one more thing, I think
course.
it's very important who you ask in the firm, because people who are in charge of pay reviews and pay increases, they do know what CPI inflation or PCE inflation is.
So my understanding from Molly and Joris' work is that actually they surveyed the C-suite of firms, and there they found limited evidence. And of course, I'm with you that at the end of the day, we have to also better understand who are the right people to ask. But there's evidence that at least some people that I think might be important for firm decisions possibly have a less good information of overall inflation. They're way better informed about sectoral specific inflation. That's definitely also something we see in the data.
Mm-hmm. So perhaps could both of you comment, or either of you comment on how important, so going forward, forward guidance might be a really important tool for central bankers in the US and maybe elsewhere. Given the research on sort of monetary policy effectiveness and inflation expectations, what do central banks need to do to help make that more effective? And in terms of forming expectations, central bank independence is an open question. So,
I think actually, as Silvana alluded to during her presentation, I think central banks have been really successful in guiding expectations. And one way of seeing that is just measured monetary policy shocks. Let's say from financial markets, Fed funds futures are really small. So they have been successful to manage expectations of one part of, let's say, the relevant players. For household and firms, maybe less so. And so I guess in this respect, we can maybe learn things from other central banks. For example, on the one hand, we have now amazing initiatives, let's say the New York Fed survey of consumer expectations, where they try to understand how individuals form expectations. The Cleveland Fed now following suit with their Center for Inflation. So there are indeed initiatives, or the Bank of England has done amazing work along those lines. But I think actually maybe we can even learn a bit more from more exotic type of central banks. So on the one hand, we are working a lot with the Bank of Finland. The most recent ECB decision was heavily commented on Twitter by Tuomas Velimäki, who is a board member of the Bank of Finland. He explained in plain Finnish terms why what the Bank of Finland, what the ECB did, and what it implies for the average Finn. So on the one hand, I think this was really successful in trying to getting the average Finn on board. But actually, maybe we have to even look at more exotic type of central banks. I'm not sure who's aware of what the Bank of Jamaica is doing. So the Bank of Jamaica has this really successful initiative of anchoring inflation expectations. And how are they doing it? They actually recorded reggae songs with national reggae heroes singing and making music about price stability, why you want to have an inflation target, why you don't want to have too high inflation, why you do not want to have deflation, and what all of those things would mean. So maybe differently speaking, maybe reggae is not that popular in the US, but of course it is the case that maybe rap music is more popular, or it is the case that we have sports stars that are national heroes, and thus, this is now an observation of one. I asked my, I don't even know the English for haircutter at some point, whether she thinks but her brother, who is maybe 20, 21 years old, knows what the Federal Reserve is. She said no. Do you think he knows what price stability means? No. Do you think actually he cares about what LeBron James says? Yes. So do you think if LeBron James would rap about price stability, he would listen? He said whatever he says, he would care about. So maybe this might be now a little bit far out, but this could be, you know, things we could learn from other central banks.
Oh, that's a lesson.
So I like to add two things. So let me tell you about the case of the UK. We see huge dispersion in inflation expectations depending on the segment of the population. So the people who are farther away from the target or actual inflation are people with low income and low education. Now, it's possible that these segments of the population have little impact on the key allocative decisions because, the relative income is low. However, there's a big, challenge here more broadly to try to improve financial literacy in these groups of the population so that they can improve their decision making. I think in terms of quantitative income for the macroeconomy, probably it will not be large. That's the fair thing. Is we need to work on them. The Bank of England has now different layers of communications, trying to simplify the message for groups who have lower understanding of the economy or economics. And I just wanted to add one thing. It's tricky with inflation. Coming from Argentina, everybody knows what inflation is, or it's something that people really is very pressing and very important in their lives. So people are constantly paying attention to that. Mm-hmm. So one reason why in the U.S. and other advanced economies people have are less informed about it is that it's not that relevant for their day-to-day lives.
Mm-hmm. But, that was favorable takeaway from one of your results. So we can take some questions. If we could take a few, we'll take a few at a time, and then Olivier, could you state your name, maybe? I think I'm just looking for the rules.
Great papers. I have many questions. I'll just ask one to Silvana. I mean, the slope of the aggregate Phillips curve has decreased over time. If your hypothesis is correct, the simultaneity hypothesis is correct, we should not see the same decrease for the state Phillips curve. So the question is, what do we see when we actually look at the estimated slope of the state Phillips curve over time?
Yeah, unfortunately, we only have the data from the 90s onwards, so I cannot answer that question.
Yeah. Can we take a few? Yeah, yes. If that's okay, yes, please. Can you state your name, please? Go ahead.
Do I need a microphone? Yes.
Yeah, mic's fine.
Robert Schroeder with International Investor. I wonder if your survey actually tells us that people in this country, even the 40% who are the least knowledgeable, know more than some economists do. And to wit, the biggest checks that the average family writes each month are for housing, health care and insurance, and higher education. I can show you chart after chart that over the last 10 years, they have all risen much more than 2 or 3% a year. So are we measuring the wrong things when we really try to, or at least underweighting these topics when we are looking at inflation?
Okay, thank you. Question over there. And could you say your name and please stand? Thank you.
Hello, Danny Blanchflower. I just wanted to follow up Olivier's point. In a sense that if we're trying to get to what's up with inflation, we probably need to know what's changed. And I think Olivier's point is right. Because if you estimate a wage equation post-2008, the unemployment rate actually doesn't enter into a wage equation. My suspicion is, following Olivier's point, it probably doesn't enter into this inflation equation either. So presumably what we really need to see to understand the question is what's changed, rather than have a 1990 to 2017 equation. And there's also puzzles. You mentioned the wage growth in the UK is 4%. That's true, but it's also the CPI has just dipped below 2 and is now 1.7. So we have to wonder about the relation between wage growth and inflation. The two things now are going in opposite directions. But I think we need to see the structural break.
Thank you.
Can I start? And let me take Olivier's and Danny's at the same time. As you probably also know, what's dragging inflation in the UK at the moment is energy prices. So DGI inflation, domestically generated inflation, is going up, in part because of wage pressures. and the big drag is driven by this cost-push shock. But Olivier, so coming back to your point, we cannot do that, as I said, in the regional level. What's interesting, and I think reserves, further study, is that the wage Phillips curve for the US seems to be working very well, and that's the point. And even over time, it hasn't flattened as much. That's the point that Matthew wrongly has made in a very nice discussion. So maybe more to see. It might be that the cost base has changed, and in some sense, wages matter less for the CPI or PCE basket. But in wage space, it seems to be working well, and the flattening is less clear.
Yes, so you raised many important points with your question. I think one way of thinking about it, I think the points you alluded to, those are price changes that are very salient, important for in daily life, and easy to measure. Instead, if you think about an iPhone, let's say, had a price of $999 for the last 15 years, even though an iPhone today is a very different animal than an iPhone like 15 years ago. So official statistics take this into account, do a quality adjustment, which actually, of course, we in our maybe calculation of my personal inflation rate, I would not take into account. So there are many, many subtleties, and I think maybe Alberto will also talk a little bit later about some other things that actually enter exactly this discussion you were raising. I think it's definitely important that people tend to think about these big ticket things in their daily lives that are important, but might ignore maybe other things that actually might trend down, like electronics more generally.
Microphone, please. Take 3 more questions, and then if you could make them brief, please, so we have time.
Peter Doyle, 1 point and 1 question. On Jamaica, the videos that you refer to came out after inflation had been lowered. So their particular role in what happened in Jamaica is probably contradicted somewhat by the data. My question about inflation undershooting for a long period of time in the United States, to what extent do you think that's a possibility? The possible explanation is that the central bankers themselves do not believe in 2%. They take to themselves the judgment that it would be better for the United States and for others to be below 2, and hence that's what they deliver.
Thank you. Yes.
Thank you, David Benowitz. I'd like to expand on a comment that was just made, and that is that lower income people do see higher rates of inflation because of this quality adjustment thing. And this could be a large part of why so-called lower IQ people see have a higher expectation of inflation, because they're seeing higher inflation. And does it really make sense to measure inflation the way it is now?
Okay. We have a question over here.
Thank you. Blarina Ruchi from Barclays Capital. I noticed in your Phillips curves regressions, especially Professor Silvana, that there was no control for a relative import price, and I was wondering what the thinking was there. And then for both of you, perhaps to comment whether import prices have play a role in the recent weakness in inflation. For example, in the data, we notice a distinction between core services and core goods inflation in the US, both in CPI and PCE. For about 2.5 decades, core goods inflation has been almost zero. At the same time, these are the components of inflation that have a higher import penetration, are more globally competitive.
You want to talk about the...
Yep, taking the last one. Obviously, CPI import inflation is important. We control for past CPI inflation as a way to capture those past pressures, but you could also add measures of import price inflation directly. It wouldn't change a lot the slope, but I think that would be the right thing to do if you have enough power to also capture those. We do control in the final one for aggregate effects, which in principle should affect the whole country equally. So to some extent, some of these effects might be absorbed there. I won't comment on the undershooting and the Fed, just to say that, one possibility is that, there's, the economy could, the monetary policy could be potentially more expansionary, and it depends, again, on how much weight is put on achieving the target or not. So let me just stop there.
Maybe just a quick remark on Finland. So I guess from the perspective of the US, we might actually call Finland a socialist country, which means that actually there's not a strong correlation between IQ and income. So in microdata, the correlation is about 0.15. So I think that's a nice testing ground because it allows you to disentangle effect of cognitive abilities from effects of income, education that is free, everyone can go to college. And so therefore, actually, I'm pretty confident that I can actually, at least in that specific setting, disentangle the effect of cognitive abilities from things you have raised.
Interesting. Okay, on that, I think we can thank our panelists.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.